So my topic for today's presentation is peer-to-peer lending. I am Mehak Singla of Section B. So what is peer-to-peer lending, which is also known as social lending or crowd lending? It is a method of borrowing and lending money without the involvement of traditional financial institutions such as banks. It connects individual borrowers directly with individual lenders through an online platform. The first prominent P2P lending platform, Zopa, was launched in 2005 in the UK. How P2P lending works. First, the steps for borrowers. Borrowers apply for a loan on a P2P lending platform providing personal and financial information. The platform evaluates the borrower's creditworthiness using algorithms and credit scores. Once approved, the loan request is listed on the platform for lenders to view. Lenders can invest in portions of the loan or pool their money to fund the entire loan. Borrowers make monthly payments, which are distributed to the lenders based on their investments. Lenders sign up on the platform and they can invest as little or as much as they wish. Lenders browse the loan listings and choose which loans they want to fund based on risk, return rate, and borrower profile. Lenders pool their funds together to provide the loan to the borrower. Lenders then receive interest payments from borrowers, which are distributed over time. What are the key players in P2P lending market? Which includes the platform providers and investors and borrowers. Platform providers include the lending clubs, Prosper, Funding Circle, RateSetter, and investment and borrowers include the investors and the borrowers. Investors are the individuals or institutions that seek higher returns by lending money. Borrowers are the individuals, small businesses, or even startups in need of funds, typically facing difficulty in obtaining loans from banks. So, what are the benefits of P2P lending? The benefits for P2P lending include two segments, one for borrowers and the other for lenders. For borrowers, it offers the lower interest rates, fewer restrictions, and faster approval. And for lenders, it includes high returns, diversification, as it allows lenders to diversify their investment portfolio by funding multiple loans across different risk levels. It also offers direct control to lenders. Lenders can choose the loans they wish to fund, giving them control over their investment strategy. P2P lending comes with benefits as well as risk. Risk for borrowers and for lenders. For borrowers, there is limited loan availability. If borrowers have poor credit scores or inadequate financial histories, they may not be able to access the loans. There is risk of denial among borrowers. Unlike banks, where relationships are built over time, P2P platforms can quickly reject loan applications based on algorithms. For lenders, it includes risks like credit risk, platform risk. The platform itself could fail or face financial trouble, affecting the investment and loan process. There is lack of insurance for lenders. In most P2P lending models, there is no deposit insurance or similar protections that traditional banks offer. Liquidity risk. It may be difficult for lenders to sell their loan investments before the loan term ends, leading to a lack of liquidity. Then there are types of P2P loans, which includes personal loans. Personal loans are used for various purposes such as debt consolidation, home improvement, or unexpected expenses, usually unsecured and based on the borrower's creditworthiness. Business loans. Small businesses can access funds for expansion, inventory, or capital needs. These may be secured or unsecured loans. Real estate loans. Used for purchasing or refinancing properties, often secured by the property itself, reducing risk for lenders. Then comes the last type of loan, which is student loan. P2P lending platforms may also offer funding for educational purposes. Global P2P lending market. The global P2P lending market is projected to grow significantly over the coming years. Increased adoption of online lending platforms and the growing need for alternative lending solutions contribute to this growth. Regulations. Many countries have begun regulating P2P lending to protect both borrowers and lenders. In United States, P2P lending platforms must comply with securities laws. In China, the government has introduced regulations to control risk and prevent fraud. In the European Union, regulations vary by country but typically aim to protect consumer rights and ensure fair lending practices. Artificial intelligence and big data in P2P lending. Platforms use AI and big data analytics to assess borrower risk and creditworthiness, streamlining the loan approval process. Some P2P platforms are exploring blockchain technology to create secure, transparent, and decentralized lending systems. Now, what is the future of P2P lending? Integration of AI and machine learning, advanced data analytics for more accurate risk assessments, decentralized finance, DeFi, the rise of blockchain based lending platforms that enable peer to peer lending without intermediaries, expansion into emerging markets. P2P lending platforms are increasingly expanding into developing countries where access to traditional banking services is limited. What are the challenges? Regulatory uncertainty. As P2P lending continues to grow, governments around the world are working to create comprehensive regulations. Trust and transparency. Ensuring transparency in the lending process and building trust between borrowers and lenders remains critical. Therefore, peer to peer lending has revolutionized the way individuals and businesses access and provide funding. With its low cost structure, greater accessibility, and potential for higher returns, it offers an alternative to traditional banking systems. While risks remain, particularly for lenders, advancements in technology and regulation could improve its stability and sustainability. Thank you.